How trusts are taxed. This video may be a little bit more dense than some of our other ones, so you may find it a little less fun, but it's still very important. The first thing to note is the difference between a revocable trust and an irrevocable trust. A revocable trust is going to be taxed to the trust maker or trust makers. Sometimes the trust maker or trust makers are called grantors. That's the term that the IRS code uses, the Internal Revenue Code. If your trust is revocable, it's taxed to the trust makers. Shows up on the trust maker's individual tax return and just flows right through. No separate tax return required. Very, very straightforward and easy. If the trust, by contrast, is irrevocable, then it can be taxed as a grantor trust. That means it flows through the trust maker's individual tax return, or it can be taxed as what's called a non-grantor trust. If your trust is a non-grantor trust, you state in the trust, that you being the trust maker, you state in the trust what happens to the income generated by the trust. You can write a trust that says trustees should distribute all the income out to the beneficiary. You can write a trust that says the trust should keep the income generated by the trust within the trust. Or you can write a trust that says the trustee decides what will happen to the income. They can either spit it out to the beneficiary or they can keep it in the trust. This is what's known as a discretionary standard for the income question. One thing to note that's really important is that in almost all circumstances, if the trustee distributes distributes income out to the beneficiary instead of keeping it in the trust, the beneficiary is going to pay a lower amount in taxes on that income than if the trustee had kept it in the trust. You keep it in the trust, it's probably going to have a higher tax rate. If you spit it out to the beneficiary, it's almost certainly going to have a lower tax rate. So why would anyone keep income in the trust? Well, the reason is it hits a big point in estate planning, and that is that taxes are not always the only concern. What if the beneficiary is experiencing extreme distress? What if they're getting sued? What if they're experiencing a crippling addiction? What if they're in prison? Or what if they're a terrible money manager? These might all be reasons that the trustee decides to keep money in the trust, eat the higher taxes, because spitting it out to the beneficiary just to enjoy a lower tax rate is going to result in a higher burn rate of that money. It's going to be not a good consequence. These are tough questions. So, to sum it all up, how are trusts taxed? If it's revocable, easy. Flows on the individual's tax return, the tax return of the trust makers, no separate tax return required. Couldn't be easier. If it's irrevocable, you could write it to where it does that. It flows through the tax return of the trust maker and it's still very easy. Or you could write it to where income is withheld in the trust, income is spit out to the beneficiary or beneficiaries, or it's a discretionary standard. So this topic may be a little bit more complex than you might have thought, and that's why it's always a good idea to seek someone's help when drafting, forming, and funding a trust.